This ascertains the change in a variable that will push the project to 0 NPV. This ascertains the change in variable. This ascertains the change in variable that will push NPV, that will push NPV, that will push the project to 0 NPV, sorry, that will push the project to 0 NPV. Now, what do you understand by the term as a break-even point? If you talk about break-even point in business, what comes to mind? Normally, when you're running business, you will first spend some money to start the business. And then at some point, you will start making some profit. But just before you make the profit, your revenue must be equal to expenses. So when you start any business, you realize that maybe you have spent something, maybe in monthly, you're paying as you market and do administration activities, you'll be spending maybe something like 500,000, or let me just say 100,000 per month to take care of the recurrent bills. So this is the cost. This is the cost, all right? Variable cost. But the revenue that you'll get might not match this. Probably the revenue that you're getting is 80,000 per, that is the revenue per month. So you find that you have a deficit, you're making losses. You're making losses because the business has not picked up, so many customers do not know you. But with the time, they will get to know your product and like your services. Now, at that time, you now start having an increment in terms of revenue, right? And you'll reach a point where you are not making losses now. The revenue will be equal to the cost. The revenue is equal to cost. So this one is revenue. This one is cost. So what profit are you getting when revenue is equal to cost? What kind of profit are you having? How much profit are you making? When revenue is equal to cost, how much profit are you making? How much profit are you making? You are making zero profit. Thank you so much. So the profit is basically zero profit. Now, let me just remind you of something that we did during that time. I was able to remind my students who were there at that time that NPV and profit are basically the same. NPV and profit are basically the same because we say that NPV is equal to the free cash flow times discounting factor minus IO. And IO is the initial cost of investment. That is the money that you spend in starting the business. Discounting factor. So this one is basically the net revenue, net profit that you're getting, net profit that you're getting annually. But now, because you want to compare it, you want to subtract the initial cost, you have to discount this. That means that the future cash flow do not have the same value with the current cash flows. So therefore, you need to discount them, bring them to their equivalent value today by discounting. So therefore, basically, you are discounting to net profit. It is the same profit that you are now discounting to bring it to its net value, what we call now present value. When you discount the cash flows, future cash flows, you get present value. This present value, if you minus the initial cost of investment, you get NPV. So basically, NPV is like the profit that you're making. So a situation where the NPV is zero, then that means that the business is also not making loss and the business is not making profit. So it is basically at zero, right? Because if NPV is the same as profit, at the profit point, when profit is zero, we are not making losses and we are not making profit. We are basically at equilibrium. Therefore, we are saying that break-even point, we are trying to look at a point where the company's NPV is actually at zero. So you might find that when you are calculating or appraising a project, at the first point, you might think that the project is making some profit. When you are appraising project, at the first instant, you might realize that it is making a profit. And then kuna changes. There are some changes that can be done. So if there is a change that can make the company not to make profit, a change that can reduce NPV from whatever figure it was to zero, that is now what we are trying to look at. We are trying to look at that change that will bring NPV to 0. That means that let's look at it in a simple way. If our cost was 800, if our cost was 80,000, then that means that we're making a profit of 20,000, right? So in this profit is what we call NPV. So if you're making profit of 20,000, because the revenue is 100, cost is 80, so profit is 20,000. We are trying to look at a percentage change on cost that can make profit become 0. So that is the same thing. We are looking at the change in variables. The change in variables, whether it is revenue or it is cost, that can make NPV become 0. So that means that definitely the cost must go up. The cost must go up by additional 20,000 for us now to come to 0 profit, right? If you add 20 here, you are having 100, which is equivalent to this 100 here. So that means that there must be adverse variance in the cost. It has to go up for us to have a 0 profit. That alternatively, the change on revenue that can make us have 0 profit, the revenue must go down by 20,000 so that we can have a total of 80, which will definitely match the cost. And at that point, we are now saying that we are at equilibrium or breakpoint. The breakpoint is where NPV is 0. So we want to look at the movement that can actually make NPV 0. Our focus is to make NPV 0. That is the breakpoint. You can read again what I've just given you. It says that it ascertains the change in a variable. The change in a variable that can make NPV, which is the profit, to become 0. Like now we know the change can be 20, or the change can be 20 adverse. It can also be 20 adverse. So what is the percentage of that 20? We are looking at that percentage change now. The examiner in break-even point, the examiner will not give you the percentage change. It is you now to calculate, all right? The examiner will not tell you the amount, like what we have seen in sensitivity analysis under impact. You are given a change in one of the items. They could tell you that there was a reduction in revenue by 20%. What will be the implication in NPV? That was impact analysis, which we did at 4. But now we are looking at the change in that variable that can make NPV 0. So that is what we call the breakpoint sensitivity analysis. You can proceed and say that at breakpoint, NPV equals to 0. Write for me that at breakpoint, NPV equals to 0. At breakpoint, NPV equals to 0. Let's look at an illustration. We shall do one illustration here, and then we can look at past papers. We shall do one illustration for this, and then we look at one of the past papers. Illustration. Kindly feel free to ask any question so that we can move together. Thank you so much. ABC Limited. ABC Limited. ABC Limited. ABC Limited wants to buy an equipment. ABC Limited wants to buy an equipment costing Kenya shillings 500,000. ABC Limited wants to buy an equipment costing Kenya shillings 100,000. Guys, remember, we are tackling topic number 1. Topic number 1 is mandatory in exam. It has to come, and it is normally 20 marks. So you don't have an alternative. You need to be attentive. You need to be asking questions. Be active and attentive so that we can help each other. So, lazima ikuje, na ikikuje inakuja question number 1, and you might not know where it is coming from. In my introduction class, I explained the areas that we need to cover in topic number 1. They are quite wide. We have only covered 2 areas, and it is quite wide. So any can come. So we need to be very keen, ask questions where necessary. I beg you, kindly ask questions so that I can know that you understand. Thank you so much. We are saying that ABC Limited wants to buy an equipment costing 500,000. So what is this 500,000? The initial cost of buying the machine, when you want to invest in a project, the initial cost, which we call initial outlay, is normally called IO. So it is the initial amount that you put in place. So when you're doing exam, you can start noting them down. As you read, you note down. So from this question, we are told that ABC wants to buy an equipment costing 500,000. So you can say that IO, initial outlay of this project is 500,000. In exam, you write it somewhere like that. You write it somewhere like that. It has a useful life of 3 years, after which, useful life of 3 years, after which it will be sold. It will be sold as a scrap, as a scrap of 80,000. So we have initial value, initial outlay of 500,000. That is a machine that we shall buy so that we can invest that machine into some business. We buy it 500,000. We know that useful life of this machine is how many years? 3 years. 3 years. 3 years. 3 years. It has a useful life of 3 years. It has a useful life of 3 years, after which it will be sold. After which it will be sold as a scrap or scrap for Kenya shillings 80,000. The scrap value is Kenya shillings 80,000. After which it will be sold at scrap of 80,000. That means that the machine will not fully depreciate to zero. Haitaisha kabisa. Hata ikiisha after 3 years, bado tutaiuza na tutapata kitu. Sasa na hiyo pia itakuwa revenue. Ni pesa tutapata kama income. So we can buy a machine, invest it in a business. During the period when the machine is still there, we'll be getting some monthly income or annual income from the business. But at the end, when the business stops, we sell that machine. That is additional money. So that means that we shall have money flowing from 2 directions. There is one that will come from the normal operation, which is the normal income, monthly or yearly. And then we shall have the final value that will come when we sell the property or the machine. Are we good? So in exam, when you are reading, listen carefully along the lines. You will need to understand and interpret in a practical perspective so that you can be able to know what these people are talking about. All right. Now, 80,000 is the scrap value. For each of the 3 years of usage, for each of the 3 years of usage, I hope you are writing, for each of the 3 years of usage, for each of the 3 years of usage, for each of the 3 years of usage, the equipment is expected to increase. The equipment is expected to increase both sales revenue and operating cost by 600,000 and 400,000 respectively. For each of the 3 years of use, for each of the 3 years of use, for each of the 3 years of usage, the equipment is expected to increase the sales value or sales revenue. For each of the 3 years of usage, the equipment is expected to increase both sales revenue and operating cost by 600 and 400 respectively. By 600 and 400 respectively. So what do they mean when they say every year we shall be getting such kind of an increment? What we are basically saying here is that, you know, if you are an accountant or an auditor, you understand that at the beginning of the year, every year, we start, P&L items start from zero. P&L item start from zero. When financial statement or financial year ends, the profit and loss goes to zero, you start afresh in January. So that is the increment. Every year, we are going to have an increment from 0 to 600 by the end of the year. That is revenue. Cost will also move from 0 to 600, meaning that we are going to get revenue. In simple terms, revenue will be 600,000 and cost will be 400,000 every year. It increases from 0. So we can be able to say that as well, that our revenue is expected to be 600 annually. Revenue for each year. Revenue will be 600,000 every year. And of course, we are told that the cost, operation cost, will also be 400 annually. So that means that how much is our profit from here? From that information alone, we can be able to conclude that our normal profit will be 600 minus 400. That is the operation profit. Operation profit will be that, and that is basically 200,000. 200,000. Operation profit. Operation profit will be 200,000. One thing that we agreed with this particular class during daytime, we agreed that the operation profit is basically the profit before depreciation and tax. That is what we say. Operation profit is the normal profit after removing only the operation expenses. So it is a profit before tax and depreciation, or depreciation and tax. The examiner said that for each of the 3 years of usage, the equipment is expected to increase both sales revenue and operating cost by 600,000 and 400,000 respectively. I hope you've written that. 600,000 and 400,000 respectively. Full stop. Full stop. You continue and say, the company's cost of capital is 10% and the tax rate is 30%. The company's cost of capital is 10% and the tax rate is 30%. The company's cost of capital is 10% and the tax rate is 30%. The company's cost of capital is 10%. Cost of capital is 10%. So cost of capital is the same as return on investment. Cost of capital is the same as return on investment. So it is 10% and the tax rate is 10%. Now, one thing that I was also reminding my team is that whenever you're given tax, depreciation becomes relevant. It becomes relevant. When you don't have tax, even if you're given depreciation, it is irrelevant. It is irrelevant. So. But when tax is there, depreciation is very important. And we were able to see why it is very important. I'll be able to illustrate to you right now why whenever they mention tax in this kind of scenario, then it is very important for you to consider depreciation because it becomes relevant. Whenever there is tax, depreciation is always relevant. Required. Number one, calculate the NPV of the project. 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 That is Roman 1. Calculate the NPV of the project. Roman 1. Calculate the NPV of the project. Roman 2. Carry out sensitivity analysis. Carry out sensitivity analysis of the cost of the equipment. Carry out sensitivity analysis on the cost of the equipment. Cost of the equipment. Sensitivity analysis on the cost of the equipment. Scrap value and sales revenue. Scrap value and sales revenue. Now, when you look at this particular statement, they have not mentioned the percentage of variation of the scrap value or sales revenue or the cost of equipment. They are now telling you to create the sensitivity analysis of this. Therefore, that means that is an impact, it is a break-even analysis. If it is impact, they will tell you to perform sensitivity analysis given a percentage change on these variables. They will give you percentage change on the variable. But in this case, they are so silent. They have not mentioned any change in the variable. They are telling you now to get sensitivity analysis. Therefore, that makes it break even. There are two differences that you need to understand. The difference between sensitivity analysis, which is break even, and also the sensitivity analysis, which is impact analysis. Solution. The first thing that you need to know when you're now solving this first thing you need to know, how do I get, whenever you're told to get sensitivity analysis, or even you're told to calculate NPV, you can only get sensitivity analysis when you have calculated NPV. So step number one is to get NPV. Some examiners will tell you carry out sensitivity analysis without mentioning anything to do with NPV. But the good ones will remind you that you need to determine or calculate the NPV. Because NPV is what we are looking at. Sensitivity analysis is basically about the percentage change. And we are focusing on NPV. So there's no way you can calculate sensitivity analysis without looking at the NPV. So for us to get the NPV, you remind yourself that NPV is normally the free cash flow times discounting factor minus IO. How do we get free cash flow? Discounting factor we can get. Why? Because we have the percentage of return or cost of capital. IO we have, but how do we get cash flow? Free cash flow, you always get it by getting the profit before depreciation and tax minus depreciation minus tax plus depreciation. Meaning that you take the normal operation profit, you deduct depreciation, tax it, and then add depreciation. You tax it and then add depreciation. So you take the profit. You need to know how do you get profit for that company annually. How can I calculate profit annually? So from the information that you have, with us we have calculated the profit, but that will be a challenge to some people. Once you have calculated the profit, we call it operation profit, then ask yourself, is there a way I can be able to deduct depreciation? You might remove the depreciation if tax is there. If there is no tax, depreciation is irrelevant. It is irrelevant if there is no tax. But here we are given tax rate, so depreciation is very important now. And I want to show you how important it is. So we have our profit before. This one is called profit before depreciation and tax. Profit before depreciation and tax is given us 200,000, right? Per annum. This one is per year. Now we need to deduct the depreciation here so that we can get profit before tax. Profit before tax. So we less depreciation, less depreciation. Why? When we are looking at free cash flow, we are looking at cash flow that is not attached to anything. Cash flow that you can even keep in the bank and nobody can disturb you. But the way it is here, when we still have it as operational cash flow, which is profit before depreciation and tax, the government is still looking for some money. We still owe the government some money. So it is not free. It is not free because we have not paid tax. The government told us that tax is 30%. So we need to remove that tax. And for you to remove the tax, you need to less depreciation first so that you tax the balance. In taxation, you need to remove depreciation first, then you tax the balance. So that is why depreciation is very important here. That now it can help us know the amount that is taxable. So for us to know the amount that is taxable, we less depreciation first. So depreciation per annum is given us the initial amount that we are having was 500,000. 500,000. That is the amount of that we use to purchase the machine. But at the end of the day, the amount that we shall not depreciate is 80. 80 tabaki. So the difference between the two is what has been depreciated. Even if the examiner is silent, always assume that depreciation is on a straight line basis. So you can depreciate it equally. Tafuta ile amount ulikuwa nayo, the initial investment was 500. Less there is residual value, or they call it scrap value. That difference is the amount of depreciation for the whole 3 years. Like now, in this case, it is 42 or 420. That is the depreciation amount for the whole 3 years. Divide it by 3 so that you can get per annum, because we are calculating even this one is also per annum. So get me depreciation per annum. So we are going to have our 42. So 42, 420 divided by 3. When you divide this by 3, it is how much? How much? Someone to calculate for me. 420 divided by 3. 420 divided by 3. Tell me the value. 420 divided by 3. We agree that you need to make calculator your friend. It is part of examination. You can't afford to do exam when you are very slow in typing. So get used to
140,000. 140.
140. Thank you so much. Thank you so much, Violet. So we have 140. So it means our division here is 140. So we less 140 per annum, right? So we are going to have how much? This one looks like 60,000. So 60,000 is now our profit before tax, because we have removed depreciation. So we can now tax it. So profit before tax is 60,000, right? Now, you less tax. You can now tax this. Don't tax it when depreciation has not been deducted. Deduct first. You now tax at 30%. Use the rate that examiner has given you. Don't use the rate for Kenya corporate tax rate. Use the one that examiner will give you. It can be 40, 25, or even 20. We are given 30. So 30% is 18,000. So your profit after tax, which we call profit after tax, is now 42,000. So you have paid the government. This money has gone. You have paid the government. Hii imetoka literally, umetoa kwa bank na ukalipa serikali. So it is cash outflow. Lakini even though we deducted 140, it is just an imaginary figure. Depreciation is an assumption. Sasa, it is just an estimation. There is no money that left our account called depreciation. So because of that, we are looking at the actual cash flow. Ile pesa imetoroka hivi ama imeingia. So this one bado iko kwa account. In terms of accounting, we deducted it. But in terms of the actual cash flow that left our account, bado iko. Sindio? So we add it back because we only deducted it for the purpose of calculating tax. But when we are now looking at the actual cash flow that we have available in our account, we add it back. So add back. Add back. Yes? Some question? No question. Sawa. So we add 140 back. I hope that you understand why we are adding the depreciation back. We are adding because we are looking for the cash flow. So we deducted just for the purpose of calculating tax. And we managed to pay the government what belongs to them. Now we add it back so that we have our real money in the account. So you add it back. So we are having 182. This is now what we call free cash flow. Free cash flow. This is money available freely in the account without anybody claiming. Are we together there? Kindly confirm to me on the chat that we are together. Confirm to me that we are together. Thank you, Faith. Thank you, Violet. Yes. Thank you. Now, one thing that I want to tell you, last semester I was a very happy lecturer or teacher. I taught this unit, and most of the students who are in class, I only had around 20 students, only 20 last semester. Those students, when they did exam, do you know that only 3 failed? 17 passed this paper. I couldn't imagine. In fact, there are some questions that came exactly the way I taught, like mergers and acquisition. It came exactly the way I taught with the figures. So what I'm telling you, there are 2 things or secrets of passing FM. Number 1, be very active in class, respond. Number 2, make sure that you don't miss classes. Make sure that you don't miss classes. Most students will come on and off. FM, class name is not a joke. I also mark this paper and I know what happens that every sitting, 50% ndio wanapita. In fact, saa zingine hata less than 50. Things like audit, 50%. Sasa 54% ikipita, surely. Na FM, watu wanaanguka. Just because students don't take CPA seriously. It is not that the paper is difficult. And then, today I was seeing somebody asking on WhatsApp, ati mwalimu, how can I go for remarking? Achana na story ya remarking. Just dedicate your time and I can assure you all will be well. Sasa, remarking you'll pay 7,500 or whatever the figure is. And then later, they will now mark wakiwa strict. You know, when you go for remarking, ni kama unabishana na classmate. Those people will be strict. They will be marking as per the marking scheme. Kwanza wewe ndio unasoma. Kama ni theory, even if they give you free marks, sasa wanakwambia hebu soma hiyo question number 1. Theory inasema nini? Okay, marking scheme inasema na hiyo hujaandika. Wanatoa zote. You'll even get less than what you're supposed to get. So, my advice, always dedicate your time, the 3 months. Give me that 3 months. Just assume that your weekend is spoiled, your weekdays are bad for 3 months, and then you celebrate. So don't get tired, usichoke. Na tena usikasirike, hata nikikuita uingie class usikasirike. It is for your own benefit. I'm just happy when I see you sending me the message that mwalimu, finally I'm done. That is what makes me happy. Sasa certificate ni yako lakini furaha ni yangu, si ndio? Sawa. So now we have our free cash flow. Now this is the cash flow that we can now discount. So how do we do it? We now come and now calculate our NPV, because the question was asking that we need to do NPV. And the period, you remember, 3 years, cost of capital still remains. We were given the cost of capital to be 10%. So we can calculate our NPV. So come here and say that NPV is equal to the cash flow which we now know, that is 182. And in some cases, this cash flow, they might tell you that the board have decided to create some money, to save some money for future investment. Yani wameamua that kila mwaka tukitengeneza pesa kama hiyo, tutakuwa tunachop kidogo, tunaweka kando ya investment. If they tell you that there is any amount that they need to keep for capital investment in the future, deduct it from this. Now balance ndio itakuwa cash flow. So deduct that capital investment, then the balance ndio sasa itakuwa free cash flow. Sawa. Yeah, save for them that amount. Now you can play with the balance. So we come here and say discounting factor times minus IO. Now my question is, which kind of discounting factor is this? Our profit is annually for 3 years. So it means that it is annuity. If it is regular, then it is annuity. If it is irregular, then you can use the other formula, which is PV. So we have PV and we have PV. For annuity, this is called the present value interest factor of annuity. The formula you still remember. I know you remember this, because it is very simple. You don't forget this. Remember this until you do your last paper in exams. Always remember this formula until your last day with CPA. Until you see your result. Then PVF is very simple, just like this. That's PVF. This is for irregular cash flow. But this one, regular cash flow. Regular. This one is regular. Regular cash flow. Regular. It means that that cash flow comes the same amount every year. So therefore, we know that 182 was for per annum, and even now the product is per annum. Therefore, this one is per annum for 3 years. So we are using this formula and not this one, because the cash flow is the same for the 3 years. So how do we calculate our discounting factor? Now this is what we call discounting factor. Discounting factor can either be PVFA or PV. So we are now using PVFA because we understand the cash flows are the same every year for 3 years. So you come and say 1 minus into 1 plus R is 0.1 into -3. Because 3 years, this period, 3 years, all over R. And I was saying that you need to have this under the all of this. Weka the all of this. Sio hapa peke yake, sio under hii peke yake, alafu naacha hii nje. You'll get it wrong. Can you make it the all of this? 0.1. Okay, those who have calculator will tell you that this one is quite similar to 1 minus into 1.1 into -3 all over 0.1. And if that is the case, then I also need to take my calculator so that I can confirm what this can be. So it's 1.1, then you raise to power negative 3. I'm getting something like 0.7513148. So I take 1, this one now, 1 minus the answer, I'm getting 0.24865. But then I can now divide it by 0.1. I divide the whole thing 0.1. So this means that my discounting factor is 2.4868, which I can round off to 69. I hope that you're having the same so that we can match together. So if that is the case, then you can confidently write it here. You can confidently write it here as 182,000 times a 2.4869 minus, so all of this you calculate first, you use body mass, then now you come and now subtract the initial outlay, which was 500,000. We have not forgotten, right? We have not forgotten. But to me, if I calculate this, it is coming to be something like 452. And one thing that I was almost forgetting is that we also have the last residue. See, kuna scrap value. Yes, there is a scrap value that we need to add. But that scrap value comes at the end of the 3rd year only. So there is scrap value that we need to add here. So you add this. This is the normal cash flow from the business. And then we have scrap value, which will come here, which is 80,000. So you pay 2,000 at the 3rd year. But because it is one-off, not every year, here we use PVIF, not PVIFA. Sawa, because 80,000 is an income that will come at the last year, one-off. This one we're using PVIF, PVIFA, because it is regular for 3 years. This one is only on the 3rd year, one-off. So it is PVIF. Now you can minus the initial outlay. So we have this plus now 80 times PVIFA. PVIFA is basically like this. No, PVIF is basically like this. 0.1 into 3. Calculate for me that. What are you getting? So it is 1.1 raised to negative 3. So you're having 0.7513. So you multiply that with 0.7513. If we didn't have scrap value, then we will just calculate this, then we minus IO direct. But because we shall get some revenue from the scrap value, we need to discount and get the present value of the future cash inflow. We shall get 80,000 after 3 years. What is it equivalent today? Equivalent of this amount is 80 times 0.5, because there's a discounting factor. Then now you add that as well. Minus 500 now, which is the IO. I hope that that is clear. So make sure that you discount all the cash flow that you get during that period. So we have here, this one looks like, I was calculating it 182 times 2.4869. That gives me 452,615.8 plus 80 times that. Equivalent value of 80 today, 80,000 in the future. The equivalent value is 60,000. Meaning that 60,000 today, mtu akikupea elfu 60, 60,000, elfu 60, so iko hivyo. Yeah, 60,000 today is equal to 8,000 in the next 3 years. If this is the rate that is applicable, it's equal to 80,000 in the next 3 years. So we simply add this 148 minus 500,000. Can somebody try and tell me what is the NPV, the value of NPV? So we take this plus 452, 615.8. 16.8 minus 500,000. Seems that the NPV is 12. Then we agreed yesterday. Yes, somebody is asking the lecturer Naito Nani, and what is this contact? My name is Cyprian Dennis. My contact is 07 20 525 000. Right? So I'll be teaching you audit and also FED this particular semester. So 525 000 0720 525 000. I teach at NTC College. We are basically doing online classes, only online classes. We like helping those who are busy so that you can be able to attend class like this time. Now, this one, I remind you that anytime you are told to calculate NPV, the last word, even if you are not asked, always advise the client. Always advise the client by saying, accept the project. Whenever NPV is positive, always accept. Whenever NPV is negative, always reject. Tukipata negative 1,000, you tell them reject the project. Because NPV is a profit. Nobody wants to invest somewhere where you can get losses. Especially if you can see it in advance. And probably I think the government should call me so that I can advise them on some of these projects like SGR, things that do not make sense and waste public money. We should perform, we should do appraisal first before they invest. Ndio. Napata pesa mingi ukimuuliza ingine sasa tuko nayo sijui ni ile ya kupitisha huko juu, magari zinapita juu. Pia pesa yetu inalipa hiyo. Is it really helpful? We should do for them capital appraisal, sindio? So that we can advise them reject or accept. Now, this is now the NPV. We are saying that whenever you're told to do sensitivity analysis, even if you are not told to calculate NPV, first calculate NPV. Even if the examiner only tells you calculate or perform sensitivity analysis, the first thing is to get the original NPV before any movement. Because in sensitivity analysis, we are looking at a change on one of the variables. So before any change is made, what was the original NPV? That original NPV, we normally call it base NPV, this one. Sasa kama haujaambiwa, hata kama haujaambiwa, please calculate this base NPV first and advise. Then from there, now make the change that they want you to make. Make that change now. After making the change, you now come and tell them that, okay, the original NPV was 12 million or 12,000, but after change, I can see this is now the new NPV. But let's now move on and look at how the sensitivity analysis, which is called impact break-even point analysis, works. From the formula that I've used, what I did, I calculated I mixed the revenue and cost to get you profit direct so that you can only come and paste profit here. But I can assure you that this one can be broken and still get it when we specify or we break down the components so that we can show what was the revenue here, what was the cost here. We can break it. Because if you have it here as a lump sum figure, you cannot be able now to vary revenue or vary cost when they are mixed here. So we can use another formula where we can be able to separate each so that we can clearly see this is the contribution of revenue. This is the contribution of cost. So that if you are told to vary revenue, we simply go and attach the revenue. So let's look at method number 2. I want to call this one method number 1, which is very simple and direct. Let's look at method number 2, which can now specify the variables. So call it method 2. The answer will be the same. Method 2. I can see Faith has got a problem. Faith has got a problem in terms of network, but she will overcome. So we call it method 2. That will give us the same answer. In method 2, we say that we are still going to have NPV using an equation. We use equation approach. So determination of NPV. So this is method 2, determination of NPV using equation approach. Right? Determination of NPV using equation approach. So what are we doing here? We want to break whatever the same thing, but into pieces. So we say that NPV was equal to revenue minus cost. That is what we did to get profit. We did revenue minus cost to get profit. And then from this profit, what we did again, we deducted depreciation, and then we taxed it, and then we added back depreciation. What was the implication of that? How does depreciation help us in terms of taxation, or what benefit do we get from depreciation in terms of taxation? When we take cash flow, because this one should be cash flow times discounting factor, right? If we tax cash flow, how do we benefit? I want you to understand the other alternative. How do you benefit when we tax cash flow? What we do, we have the normal cash flow will be equal to profit before depreciation and tax, which was 200,000. Profit before depreciation and tax. Then we can tax the whole of it. So if we tax the whole of it, it means that our side we shall only remain with 70%. So you take 1 minus t, meaning that tumetoa tax. So tumebaki na 70%. So 1 minus t is 30%. So tutabaki na 70%. Hiyo ndio itakuwa portion yetu, meaning that the whole of it has been taxed. So we have into 1 minus 0.3. I hope that we are together there. Then now we add back the advantage that we got by not taxing depreciation. Listen again. Our depreciation per year was how much? 140. Lakini hii 140, when we were taxing, tuliepa tax. Tulideduct kwanza, ndio tuka tax the balance, and then we add it back. Meaning that using that other formula, hii 140 iliepa taxation, haikutaxiwa, si ndio? Tulitoa kwanza, ndio tuka tax the balance. So the advantage that we got from there, we were saved from taxation by 30%. 30% of this ingeenda, si ndio? Even if we were to tax it, how much would have gone from here? 30% gava wangekula. Si ni kweli? Kama tunge deduct, government angekula 30% of this amount as tax. But the good thing is, we deducted, then we tax the balance, then we deducted, we return it back. So we were saving. That is what we call tax shield. Shield ni kama kitu inatufunika. Wakati kuna vita, you shield yourself, you protect yourself from tax. We were trying to protect 30% from it. That 30% that we have saved from taxation is a benefit to us. Now, in this case, we have taxed this amount together with the 30%. Now, what we need to know, we ask ourselves, now that 30% yetu imeenda, how do we bring it back? Because we want to shield it from taxation. So you add depreciation tax shield. You add depreciation tax shield. So add it back. So add 140 times 30% that we're supposed to save. Add it back. So it is the same depreciation times tax. That amount that we're supposed to save, we didn't save it when we tax it. When we tax this fully, we didn't save it here. So what you do, you add it back. So this is how the formula looks like. Take the operational profit, which is the profit before depreciation and tax, then tax the whole of it, then add back the advantage or the amount that you should have saved by not taxing depreciation. And that should have been 30% of the depreciation, add it back. So that's how the formula looks like. That is another formula that you can use to arrive at the same point. So can somebody tell me, if you're going to get 182 thousand. Please confirm to me if this formula can give us 182,000. $182,000. Are we shielding ourselves? Yes. So that tax we add it back because it was deducted here. So we add it back, the portion that we should have saved. Confirm to me what you're having. Is it 182,000 as our free cash flow? Faith, Violet. Yes, Violet is confirming that that is true. I want everybody to confirm.
Yes, it's true.
It's true. So therefore, this one is an alternative. So next time when you're doing such kind of calculation and I use this formula, don't say that, oh, this one, Mr. Dennis didn't show us. It's 182,000. This formula is better because it can tell you how you can vary tax, how you can vary depreciation, and other factors. So now we can now, after confirming that that is true, we can now expand this formula. How did you arrive here? How did we arrive there? So we can say that our cash flow is the same as revenue minus cost. That is this one. See, ilikuwa 600 minus 400. You tukapata 200. So it was revenue minus cost. Revenue minus cost times 1 minus T plus DT. So if you are told now to vary this, you can clearly see it. If you are told to vary cost, you can clearly see it. And even tax, you can do that. That is our cash flow. What about our NPV? NPV is now the cash flow, which is R minus C into 1 minus T plus DT. All this, which is now the cash flow, times PV for. Of course, you now need to add the residual value, which was how much? Scrap value, which was 80 times XPV. Then you can now remove the IO. Still, it makes sense, right? I don't think that I've done any mistake there, but check for me. I've just made it have some sense. So therefore, we want to see if we're going to arrive at the same NPV. So we take our revenue, which was 600,000 minus 400,000 into 1 minus T is 0.7 plus 140 times 0.3, that is this. Then all these times PV for which you got 2.4 what? 2.4. We got it 2.4869. Plus now the scrap value here, which is 80,000 times 8 PV. PV for this was 0.753 or 0.7513 minus the initial outlay was 500,000. Those mathematicians can confirm to me if you're going to get 11.7, nearly 12,719. Confirm if it is true that this formula can help us arrive at the same point. So what we're doing here, 600 minus 400, 200,000. 200,000 times 0.7, 0.7. We're going to get 140. This times this This times this, it's 42,000. Unit 42,000. So 140 plus 42,000. I'm getting 182. 182 times this, 2.4869. Then now I'm getting the all of this up to here. I'm getting something like 452, 615.8. Now discount for me this 80 times 0.7513. Then now plus 452, 615.8. Then now minus 500,000. I'm getting my 12 like that. I'm getting 12, 719.8. 19.8. How many are getting the same? How many people are getting the same? Now, it is now possible now to perform sensitivity analysis from this point, because if you're told now, like the examiner was saying, that carry out sensitivity analysis of the cost of equipment. So we can now come to cost of the equipment. We can now vary this. So we need to ask ourselves, what amount of cost, if we pay, can make us not have any profit? That is, NPV will be 0, from 12 to 0. Cost of the equipment, scrap value. How much should scrap value be to make NPV have 0? And sales revenue. How can we vary sales revenue? Revenue peke yake, not cost of operation. Revenue peke yake. How can we vary revenue in such a way that it will make the whole NPV be 0? That is now what we call break-even point sensitivity analysis. Okay, now we have our base NPV, which is 12,719.8. But we can now ask ourselves, with this good formula, how can we vary them? How can we vary them? Then we can perform sensitivity analysis of the cost of equipment. Say, sensitivity analysis of the cost of the equipment. Sensitivity analysis of the cost of the equipment. So what are we varying? We are varying the cost of equipment peke yake. The rest remain constant. So we are looking at where NPV will be 0. Therefore, we can equate, and then we say NPV is equal to 0. All right? Because we say that at break-even point, sensitivity analysis, NPV equals to 0. So this NPV will be equated to 0. So we can say that this one, NPV was equal to R, which was 600. We can pick it from here, 600,000 minus 400,000 into minus 1 minus T, 0, that is 0.7 plus 140 into 0.3. All this times 2.4869 plus 80 into 80 times 0.7513. 0.57513. You guys can't see na mmenyamaza. Kwani mnaogopa nini? Mnaogopa kuongea? Faith. Ama who is there? Faith. Mnaogopa kusema? Haya. So minus. Now this one is the one that we want to vary. If 500, which is now we are supposed to have here, that is what we don't know. We need now to ask ourselves, what cost of the machine will make NPV be 0. So let's call it X because we don't know. The original that we were having was 500. Now your 500 was making NPV to be 12,000. Now we are saying that we don't want to go with 500. We want to have another figure which can make NPV be 0. So that figure we can call it X. So we are saying that that figure that we don't know, which is X, can now make NPV not be 12,000, but 0. But 0. Therefore, we are saying when you calculate all this, we are going to have 182,000 times 2.4869, right? Plus 80 times 0.713 or 513, right? Minus X is equal to 0. That is the equation. Because we have just solved this. This is the cash flow up to here. It is the normal cash flow, which is 182. Now we discount it, and then we discount the residual value, scrap value. We minus X that we don't know. We want to know it, and then we get 0. We can now have X cross the other side so that we can have our calculation, and then we compare. When you calculate all this, what do you get? Someone to help me. What is the value of X? That is the value of X. Can somebody confirm? Therefore, that is just the new cost of capital, cost of investment, the cost of machine, cost of equipment. So for us to have NPV that is 0, the cost of equipment should be this. But the examiner is asking us to perform sensitivity analysis. So how do we do it? Sensitivity analysis, now you say that adverse percentage of adverse change, because this is cost. When cost increases, it is adverse. So you call it percentage of adverse change. Initially, it was 500, but now we are having it to be 512. So it is adverse. So you say that percentage adverse change is equal to new cost of equipment minus all over new, all over all, sorry, all over all. This is the same as 512 719.8 minus 500,000 all over 500,000, and then this times 100. What is the percentage change on the cost of machine that can make NPV be 0? That is what we're looking at. The percentage change, we know it is adverse because it has gone up. From my calculation, I think that this one let me see, 2.54%. So what are we saying? That for us to have a 0 NPV, we need to increase the cost of equipment by just 2.4%. Initially, it was 500, ikakuja 512. So that means that if you just increase the cost of equipment, NPV will be 0. Any question? Any question? Can we proceed? Can we proceed? ama kuna mahali hatujaelewa? Kama iko sema, well, it is okay. With ibet, with ibe, Philip, Sally, Philip, welcome. My name is CPA Dennis. I am CPA Dennis. I teach AFM at NTC College. We are purely online college. We like making students pass exam with ease. So Kibe is saying that we can proceed. Thank you so much. So that then, now that there is no complaint, we can just proceed. Okay. So we are told that we can also perform sensitivity analysis on scrap value. Sensitivity analysis of scrap value. So let's have scrap value here. Wewe utaandika, lakini mimi na rap tu kidogo. Wewe utaandika sensitivity analysis of scrap value. Sawa. Sema hivyo. So that means that we want to look at the amount of scrap value that can make IO, or that can make NPV be 0. So what are we doing? We simply change the scrap value. In exam, let's copy everything the way they were. The only thing that you're changing here is scrap value. You call it X. So we have X times 0.7513. So you call it X. The rest remain. After hii sasa sio X, you can't vary two at the same time. So hapa we return this one to 500,000. Other factors remains constant. You vary one at a time. Are we together? When we are varying the cost of equipment, the rest remains the way they are. Now that we are varying the scrap value, the rest remains the way they are. So now come here. We know without calculating that the rest will be the same, except here where we shall have some difference. We are going to have, we don't have 80 anymore. We don't know 80. So we only know X, 0.7513X, right? Minus 500,000 is equal to 0, because NPV is now 0. So we know that the whole thing will only make us arrive at 0. Here, we do the same thing. 0.7513x minus 500,000 is equal to 0. Can we make x the subject of the formula? So what do? We let 0.7513x to cross the other side. So therefore, you calculate this separately. We used to get 140 something, but I can try again. It is 182,000 times 2.4869. You get 4. So we have this one is equal to 4, 52, 6. In fact, we can do it the other side, the other way around, so that we have 0.7513x is equal to, we cross the other side, 500 will be positive now. This 500, when it crosses, it becomes positive. This times this is 452,615.8. So when it crosses, it becomes negative. So we minus 452,615.8. All right. What if you decide to subtract that? What can you get? 47,000, right? So we are having 47,000. So we are saying that now 0.7513x is equal to 47,384.2. So therefore, we are saying that x is equal to now 47,384.2 divided by 0.7513. Isn't it easy? Huh? Isn't it simple? I know you can give me that value. That one you cannot miss. My answer is coming to be 63,069.61. 63,069. So that means that for us to ensure that, remember that the scrap value was money that is coming in. The money was supposed to come in 80,000, but that would make us have a profit of 12,000. But now if you want to have no profit at all, zero NPV, then it means that the scrap value can now be sold at a lower price. So we sell it at a lower price, which is 63,069. Now, this is now the new scrap value that can give us zero NPV. But the question was to perform sensitivity analysis. Even if you get the values, new scrap value, before you now look at the percentage, you are not done with the question. If you don't look at the percentage change, you are not done with the question. We come here and say, oh, I've wrapped the whole thing. That will give me a lot of work. But anyway, we shall overcome still. So we are saying that because now this one was supposed to be income and it has gone down, we know that that is a percentage adverse. It is adverse. If it is not adverse, you just say percentage change. But this one is adverse because we don't want to show the negative sign. But we are just saying that adverse change, percentage adverse change is equal to new minus all over all times 100, right? So we're having here new 63,069.61 minus 80,000 all over 80,000. All this times 100, right? What is your calculator saying? What percentage? Mine will say something. It says that 63,069.61 divided by 8 minus 80,000, you get negative 16,930. This one, you divide by 80,000 times 100. Ignore the negative sign so that we have 21.16%. If you're getting the same thing, congratulate yourself. Yes, 21.2 is also okay, Violet. Thank you so much. That is also fine. We want to do the last part of this question, and then we can decide whether we have time to do a past paper questions or I can give you as an assignment. So let's look at the last part. The last part, they're asking you to get the sales revenue, a sensitivity analysis. Sensitivity analysis of sales revenue. So I simply say sales revenue. Ile formula yetu, sijui kama mnaikumbuka, lakini mimi nilisema that formula says that NPV is equal to revenue was 600, which is now X. So it is what we don't know. Now X, we are changing revenue. Originally it was 6, but we agreed it was 6, but now we have to change it. Minus 400,000. And then what was next? We needed to remove tax, so 0.7. Then we now do what? Add 140 times 0.3. Then all these, we say that we shall do what? Multiply with 2.8 what? I don't remember the whole thing. It was 2.8. 4869. 4869. And we say that even after doing that, we still need to add the scrap value, which was times 0.7. Then we minus 500. We say that the rest remains constant. We vary one at a time. And this is the main reason why I had to break down the formula so that we can clearly see where revenue is. And revenue is now X. So if that is the case, we can now confidently say that 0.7 times this gives you 0.7x, but this times this gives you something like 280, right? So 280, right? Plus, this one was giving us 42,000. We need to add this. And now we multiply them with 2.4869 before we add our 80. So 80 times that, it was coming to be 60 what? 80 times 0.7513, 60, 104 minus 500. And this is equal to 0, right? So this is equal to 0 because the NPV must be 0. Thank you so much, Violet. And I hope that everyone is following. I cannot know if you don't speak. Lakini ukiongea nitajua tuko pamoja. Now from here, we can proceed, right? So we have multiply this, all this. What are you getting? 2 point. Kwanza hii itakuwa negative, si ndio? This minus this. It's negative 280 plus 42. Inapata ni ngapi? 42,000. Negative 238. Right? So negative 238 times 0 point, no, times 2.4. Nimeanza na hii na hii inakuja negative 238, then multiply this, which is going to be 2.4869. So this is minus 591,882.2. Hapa sija calculate this times this. I'm only done this. So we have 2.4869 times 0.7. So we have 1.7408x is x. Then now that one plus now 60,000. Right? Minus 500,000. What are you getting there? So that is equal to 0. Right? Unapanga hesabu sasa. So tunaweza kubali wale wako na negative wavuke, right? So we have 1.7408x is equal to, wacha 500 ivuke, 500 ikivuka itakuwa 500 positive. Hii ni negative ikivuka hiyo equal sign inakuja 590,882. Hii ni positive ikivuka inakuwa negative, so we have negative 60,104. Kila mtu amevuka? Kila hesabu imevuka. So we can now have 591,882.2. I don't leave even if it is a decimal. So 2 minus now 6,014. So imevuka. Okay, so 0.2 plus 5,000. 100,000. Then the answer minus 60,104. So we are saying that now 1.7408x is equal to 1,003,1,778.2. So our X is equal to 103.1778.3.2 all over 1.7408. What is the answer? Hebu tung'are na hiyo tuende. Hiyo ndio imebaki. Tung'are na hiyo tukienda. So divide unapata 4020. 5. X is 5, 9, 2, 8, 47. And by the way, thank you so much. Ukifanya hesabu wale tumeipata. Ukifanya hesabu, it has to make sense to you. Unaangalia, does it make sense? For example, we were talking about 600 hapa, na tumepata ni 592. It is possible, it can vary like that. Lakini wewe ukipata 100 hapa na ilikuwa 600 huku, imagine na bado una believe tu ati utapita. Hiyo sasa unajua tu you are wrong. Hata wewe unaweza jimakia, ujue tu hapa naye it makes sense. Even if there is a variation, it can be like 300% or even 600% variance. Hii iko close na hii. So it makes sense. Na hata ile tulicalculate 80, tukapata 60. Wewe ukipata ati ni 900,000, you know you are wrong. You cannot sell the scrap value at 80 and then when that cost varies, it goes to 900,000, which is even above the initial cost, which was 5. So sometimes when you're doing calculation, unaweza jimakia, unaona hapa naye niko right, hii niko sure, it makes sense, it speaks. So we are saying that the new price, new revenue should be 500,000, meaning that tukipunguza revenue kidogo, hatuta make ile profit ya 12,000 because now revenue has gone down. It is adverse variation. Now I say that up to here, you have only gotten the new revenue value, but you have not calculated the sensitivity analysis. Sensitivity analysis ends when you have compared the two and look at the percentage variance. It can be positive, favorable, but this particular one is adverse. So you say that percentage variance. Kama ni positive, just say percentage variance. Lakini hapa nasema adverse because I don't want to put at negative 20%. So I just call it adverse in like that. Adverse variance or variation, which is new minus all over all. This is times 100, eh? Times 100. This is basically the same as new, which is 592, 703.45 or even 0.5, the same, minus 600,000 all over 600,000. All these times 100. 100%. I'm getting something like 1.22%. Thanks so much. Yes, Violet is even more accurate. 1.26. Actually, it is 1.216. So you're right. Thanks so much. So that should be the end of our today's class. I know that the remaining hours or remaining minutes cannot be enough for us to tackle another question. However, I'll be able to give you an assignment that you can look at your own time before we meet again. This particular assignment, it makes sense to you now, I believe. For those who are joining, kindly call admin so that you can be able to join class. We only charge 4,000 over it. It ends tomorrow, right? So it's a good thing for you. This is the question. I think now it makes sense. If you're told to evaluate the sensitivity of the project's net present value to the following changes: a change in sales volume, change in sales price, and variable cost. I know this one you can now do. Ama kuna mtu atakuwa na tashwishi? Is there matatizo, shida, problem somewhere? Let's go through that question, then you tell me if you think you'll have a challenge. So I'm giving you that assignment. We shall do it at the right time. And I don't always forget my assignments. I'm giving you two assignments. The first one is November 2019, question number 1B. This one here, 1B, November 2019. Another assignment is 2017, very similar. Lakini nataka nione vile mnapambana. Assignment makes you become hard. Makes you become more prepared. 2017 November. In 2017 November, yes. Also question number 1B. They are saying, suppose the firm's management is unsure about the savings in before tax operating cost. Carry out sensitivity analysis on this variable, assuming that the variance shall vary adversely by 10%. 8 marks. 8 marks. Najua inakuanga marks mzuri. Bona hii. Here they told you advise Viwanda on whether to buy the machine or not. 6 marks. So the total here is 14. I told you, it normally come in question number 1. So that one also, I will not forget. November 2017. And you share on WhatsApp group so that we can discuss. That is what we are used to. Question number 1B. Unatuma pale na tunaanza to discuss. How much do you charge for those doing retake? For retake right now, offer rate is 3,000. Na inaisha tomorrow, 3,000 per unit. Na mimi nataka iishe haraka ndio watu walipe pesa mzuri 4,500. Nataka iishe haraka watu walipe pesa mzuri kesho. You need just to provide evidence that is a retake. I don't know. Maybe you can provide your results for last time. Watu wengi watakuja to retake, kumbe sio retake. If you're not our students, hatuna evidence that ulikuwa last time. So you provide evidence and then we allow you join. The normal rate is 4,500. Otherwise, thanks so much. Angelica, feel free. Come with your friends. Yes. Kibe, please come with your friends so that we can have a good Quran. Najua class inakuwa tamu kama tuko wengi. Kibe akilala kidogo, Faith anapeana answer. Violet akienda kushughulikia kitchen kidogo, Faith anapeana answer. Inaendelea hivyo. So let's make a good Quran. Thank you so much. Have a good night.